So how does a massive multi-billion-dollar retailer navigate this kind of widespread economic uncertainty? I mean, the kind that really makes everyday consumers, keep their wallets shut.
And not just navigate it, but do that while executing one of the biggest strategic pivots in the company's entire history.
That tension, that's exactly what we're exploring today.
We're diving deep into the Q3 2025 sales and earnings results for Lowe's Companies, Inc. The quarter, which ended on October 31st, it's a masterclass in financial choreography.
Right. We've got the internal numbers, we have the CEO commentary, and our mission here is to cut through all the noise, all the financial adjustments to understand one thing.
Is there a massive bet on the professional contractor, their total home strategy? Is it actually stabilizing the company against what is a genuinely nervous consumer backdrop?
The source material is dense, for sure, but the story becomes crystal clear once you sort of untangle it. Let's just start at the top line snapshot.
Okay. Total sales for the quarter hit $20.8 billion. That's a modest increase from the $20.2 billion they reported in Q3 last year.
But the crucial metric, I mean, the one that really tells us about the underlying health of the stores, comparable sales or comp sales, that only increased by 0.4% overall.
And that tiny 0.4% is the perfect example of how an average number can obscure what's really happening on the ground.
A fierce battle, as you put it.
Exactly. But before we get to the customer side of things, we have to tackle the money itself. Because to understand this quarter, you have to understand the difference between the numbers Lowe's reports to regulators and the numbers they use internally to gauge their own performance. This is the whole GAAP versus non-GAAP story.
Okay, let's unpack this for you. Most people just see the headline earnings, right? The GAAP numbers generally accepted accounting principles, and those GAAP figures, well, they initially look like a major stumble.
They really do. The reported diluted earnings per share, the GAAP number, came in at $2.88. Now, that's a drop of 3.7% compared to the same quarter last year.
And if you stop right there, you'd think the company was just becoming less profitable. End of story.
But it's not. The company immediately points your attention to the non-GAAP, or adjusted figures. And this is where we see the strategic cost of their big transformation hit the income statement.
So what were they adjusting for? Why does it matter so much?
It matters because the company is making a conscious choice here. They're accepting short-term financial pain for what they hope is long-term strategic gain. The primary adjustment was for $129 million in pre-tax expenses.
Okay, and that wasn't because of poor sales or anything operational.
No, not at all. This huge chunk of cost relates directly to transaction expenses and asset amortization from two really significant acquisitions: Foundation Building Materials, or FBM, and Artisan Design Group.
So they're taking the cost of buying future business and letting it hit the books in this quarter?
That's it, exactly. And when you strip out that $129 million in strategic spending, the entire picture flips. The adjusted diluted EPS comes in at $3.06. That's an increase of nearly 6% over last year's adjusted figures.
Yeah.
So operationally, the core business is healthier, is more profitable, but strategically, they're investing billions, and that bill just happened to land this quarter.
And that strategic focus also explains the improved margins, which to me is a sign of some serious operational discipline. We saw a gross margin land at 34.2%. That's a strong increase, 50 basis points year over year.
Right, and just for clarity, a basis point is 0.01%. So 50 basis points means their gross margin improved by 0.5%. That's significant efficiency. Their adjusted operating margin also rose by 10 basis points, hitting 12.4%.
And the CEO, Marvin Ellison, he made a point to highlight that this all happened despite some challenging external factors. He specifically mentioned headwinds related to hurricane activity in the prior year.
Which suggests they're optimizing store performance even when they're facing tough comparisons to, the boom times of pandemic-era spending or big recovery projects. It speaks to strong cost control.
Okay, so the margin story is good, but let's pivot to where those sales dollars actually came from.
Because the sales growth story is tenuous.
You're absolutely right. And that brings us to the customer data. This is where it gets really interesting because that tiny 0.4% overall comp sales gain, it's being completely driven by one specific type of purchase, and it's masking distress pretty much everywhere else.
Yeah, you have to look past the average. The overall number of sales, we call comp transactions, that actually decreased by a full 3.0%.
Wow, 3%.
Think about that. They're selling to fewer people overall. But the average ticket size shot up to over $106, a 3.4% increase. So the smaller pool of transactions were, on average, much more valuable.
This is the critical insight for you, the listener. We can break down the performance by ticket size and see exactly who is tightening their belt and who is still spending freely.
Let's do it. Transactions under $100, that's your small impulse DIY buy, right? The light bulbs, the quick hardware fix. Those declined significantly, down 3.3%. Then transactions between $100 and $500, which might be a mid-size home project, those also declined, down 0.7%.
So the everyday consumer, the weekend warrior, they are pulling back universally across small and mid-sized spending. So what's holding the whole thing up?
The big bets. Transactions over $500 increased by a robust 2.9%.
2.9%.
And this segment, this high-value transaction, is almost certainly driven by contractors, professional builders, major remodels. If you're starting a $20,000 kitchen renovation, a $500 transaction is just one line item on a massive list. That high-value customer is the one singular source of comp sales growth this quarter.
Okay, so this validates the big strategic decision, but doesn't it also introduce enormous risk? If the economy slows, aren't they putting all their eggs in the pro basket? Especially since big construction projects often lag the consumer sector. Isn't this an incredibly risky time for an $8.8 billion bet?
It is high-stakes poker,
Yeah.
no doubt about it. And the volatility within the quarter just underscores that nervousness. Look at the monthly numbers. August saw a healthy 2.5% gain. That dropped to just 0.9% in September. And then October went negative, a minus 2.6% comp sale.
Whoa. That swing from plus 2.5 to minus 2.6 in just 60 days, that shows how quickly sentiment can change. That is a massive macroeconomic red flag.
It is. But amid that volatility, the product performance really shows where that pro focus is paying off. They still managed to get positive comp sales in 10 of their 14 product categories.
And the categories that were strong are very telling.
Very telling. Electrical, paint, appliances, kitchens and bath, millwork, flooring, lumber, tools. These are all categories heavily used by professional tradespeople. It just reinforces that the pro momentum is carrying the results.
Okay, let's pivot to the grand strategy itself. That pro momentum is the engine of their total home strategy, which is this 5-pillar plan to fundamentally shift who they are and who they do business with.
It's an aggressive pivot. They're moving away from being primarily a DIY store. And the 5 pillars are all designed to create this comprehensive, end-to-end ecosystem for contractors.
So what are they?
Number 1, drive pro penetration. 2, accelerate online sales. 3, expand home services. 4, create a loyalty ecosystem. That's the myLowe's rewards and pro rewards. And 5, increase space productivity in their stores.
And the centerpiece of that first pillar, driving pro penetration, that's the massive investment we saw earlier. The foundation building materials, or FBM acquisition, we know it cost $8.8 billion this quarter, but what is FBM? Why is it worth that staggering price?
This is where the real structural change happens. FBM, and to a lesser extent the Artisan Design Group acquisition before it, these are specialty materials distributors. FBM specifically deals heavily in things like wallboard, drywall, suspended ceiling systems, insulation.
So by buying FBM, Lowe's isn't just selling a contractor a tool anymore.
No, they are vertically integrating to supply the basic building materials for large-scale commercial and residential projects. This moved Lowe's out of just competing with other big-box stores and puts them into the world of specialty trade distribution.
This is a foundational change.
Exactly what Ellison called it. He said FBM will create more sustainable long-term sales and profit expansion. This is about locking in long-term, high-volume pro accounts.
And what about in their existing stores? What progress are they making there?
They're moving fast. They're building out what they call the Pro Extended Aisle. It's a dedicated, specialized inventory with services and loading areas tailored for contractors.
Bulk buying, dedicated support, that kind of thing.
Right, and that's actively being built out in 9 of their 15 regions as we speak. That investment is clearly feeding into the pro comp sales growth we saw in Q3.
And that pro growth is matched by the online acceleration. Pillar 2, online sales were up, what, 11.4%?
Strong growth. And there was a truly surprising technical detail in the source notes that connects a home improvement company to some bleeding-edge tech.
You're talking about the 100 billion token milestone.
I am. It's highly unusual. It speaks volumes about their strategy. The company was recognized by OpenAI for achieving this milestone.
Which, for you, the listener, basically means Lowe's is running massive computational models, probably using advanced AI for supply chain, inventory, maybe even sophisticated recommendations for their pro customers.
This isn't just about making the website look pretty. It's about using AI to optimize everything from where a truck delivers gypsum board to how they predict regional demand for lumber. It shows that their accelerate online sales pillar is also a massive investment in operational intelligence.
Okay, now we move to the outlook. Because despite all this confidence in the Pro strategy, the FBM acquisition, the company updated its full year 2025 outlook, and the revisions reflect a lot of that macroeconomic uncertainty we've been talking about.
This is the moment where the strategic narrative butts up against reality. They did raise their total sales forecast to $86 billion. You have to remember, that increase is almost certainly just from folding in the expected revenue from the massive FBM acquisition.
Right, that's the strategic boost. But if they feel good about total revenue, why did they lower the core operational metric?
Because the underlying consumer sentiment is still worrying them. They revised their full-year comparable sales expectation down to flat, just flat. They had previously guided flat to up 1%.
So that reduction, even with FBM now in the fold, is a signal of nervousness about consumer spending.
It's a huge signal. They are implicitly telling the market, we are relying on acquisitions to boost our total sales because our core store comps are stagnating.
And profitability guidance took a small hit, too.
A slight tap down, yeah. Adjusted operating margin revised down to 12.1%. Adjusted diluted EPS was refined to about $12.25. These aren't huge shifts, but they're clearly factoring in the pressure from those transaction costs and the consumer pullback.
So if we summarize the capital allocation this quarter, we know the $8.8 billion for FBM dominates the story.
It does, but they also maintain their commitment to shareholders. That's a key balancing act. Despite sinking nearly $9 billion into FBM, they still returned $673 million to shareholders through dividends in Q3.
Transforming the business while maintaining those consistent rewards.
It's a tightrope.
And finally, there is a detail that speaks to their community presence, which often ties back to their relationship with local pros.
Absolutely. The materials highlighted a partnership with Building Homes for Heroes, which is based near their headquarters. It's a project to build a community, providing mortgage-free housing and support for injured veterans. It's a crucial part of their broader profile.
Okay, so if we step back, distill this all down, what are the two core takeaways we need to internalize about Lowe's this quarter?
I think the report is a clash. It's a clash between investment and environment. First, Lowe's is aggressively executing a huge strategic transformation, and they're accepting intentional short-term pain, that $129 million expense, to secure a much more stable, high-value pro customer.
And second, that pro focus is absolutely essential because the everyday consumer is weakening a lot.
You see it in the 3% decline in transactions and the stagnating comp sales forecast.
That high-value transaction, the one over $500, it's the life support system right now. Without that customer, that tiny 0.4% comp gain flips negative immediately.
Precisely. And that leads us to a final provocative thought for you to consider.
The company successfully closed its major pro acquisition. They saw double-digit online growth, and yet they still reduced the full-year comp sales guidance to flat, citing macroeconomic uncertainty.
The strength is concentrated. The weakness is widespread.
So the question for you is this. Given that major construction often lags an economic slowdown and that their core consumer business is pulling back sharply, is Lowe's making an $8.8 billion bet on the pro customer just in time for that pro market to also tighten up next year?
Will the strength in those high-ticket items be enough to withstand a sustained slowdown across the entire economy? That is the essential risk and reward calculation to track in the coming quarters.
Thank you for diving deep with us today. We'll catch you on the next deep dive.